there was a very interesting report published at the beginning of this year, which most small cap managers looked at, and you probably, I would expect, wouldn't have looked at. But so I thought I'd mention just a couple of items from it. And it's a report that's published every year, which is a study of the Numis Smaller Companies Index. It's produced by a couple of professors from the London Business School, and they invented that index in the 80s, in late 80s. So they backdated it to about 1956, and every year they produce lots of fascinating data. And one of the most interesting things that jumped out at us from this report this year was this particular graph, which looks at what they call the impact of seasoning on long-term investment returns. And what they've done here really is to look at the length of time that different companies have been listed on the stock market. Then this is really talking about the full list market. And the grey line was if you just bought all the companies that have been listed for less than 3 years in 1980 and you hung on to them, that's how you would have done. And then longer periods. So if you bought the blue line at the top, if you in 1980 invested only in companies that had been on the market for 20 years or longer, then you'd done the best. And it was making a very interesting point, and the reason why we in particular found it interesting and the way it relates to us is one thing we've really noticed about the kind of work we do in the VCT is that if we can make an investment in a company that is seasoned, and of course it won't have been listed for 20 years, but it's one of the characteristics we've really started to look quite hard for is what we call seasoning in a business, and that really relates to how long have the management team been running the company, how long has the company itself been around for, how many ups and downs has it survived. What this graph was really telling us, this is a really important factor for the kind of businesses that we should look for. So if we just think about the investments we made this year, those two, Bilby and PTSG, Bilby was a business that's been around for 25 years. And so actually, luckily it was before the end of the tax year. Under the new rules, that would have been quite a problem. We wouldn't have been able to invest in it, actually. But it's one reason why we were pretty pleased to find that particular investment opportunity. The next graph, of course, is also very salutary for us. This is a study of the IPO market in the UK, and this has really been the case ever since I've been investing in UK equities, which is about 15, 16 years. The IPO market in the UK really doesn't work very well, and overall, if you take the averages, and what's really striking about this is that that's a consistent trend, and this has gone on for decades. And sometimes you get this, I'm going to press the right button here, you get this sort of spike up at the beginning, and it doesn't last, and then it carries on and it carries on down, and it's tough. And it's actually one reason why our job is really quite difficult running the VCTs, that we do invest in quite a lot of IPOs, and we invest in equal number, if not more, secondary fundraisings when the company comes back to the market. But identifying the IPOs that don't do this is not straightforward, because the average IPO, what this is telling you, is not really worth bothering with. This, of course, averages don't tell the whole story. So what I thought the next slide that we produce here is to look at our 2013 investments, which was a big group of investments. So we made 12 new investments in that year in quoted companies, so quite a number of which were IPOs, and to see if they're exhibiting this characteristic of zooming up and then coming down. And of course, the reason why they do this is the initial phase when people love the story, and then the reality bites. And of course, what very often happens with IPOs is they're oversold. So, and the real problem with IPOs is that's the moment when often founders might be exiting, or venture capital investors are exiting. So all they're really focused on is the IPO price. They want it to be as high as possible. And one of the big arguments we have with brokers at IPOs, and we have this conversation 10, 15 times a year, hard, is that I'm saying to companies, don't think about the IPO price. It's irrelevant. Yes, it's a little bit 2 or 3% more dilution here or there. What you need to think about when you float a business is, what's the share price going to be in a year's time? You want that share price to be at least 20% higher, ideally 50% higher, because if it is, all those investors who came with you at the IPO are going to love you to bits, and they're going to stick with you for years, and they'll back you through difficult times. If you kind of disregard the investors by overpricing your IPO, the chances are you're going to slip below your IPO price. And once that's happened, really you're in the wilderness for 3 years. And so we have this conversation a lot. And as you can imagine, that's not an easy conversation to have with groups of directors floating businesses because they've just seen AIM as an exit, as a kind of end point, not as a beginning point. So for us, our job, we see part of our job is to try and reorientate the management team, say, don't see this as an exit, this is a starting point, and see your investors who come with you as partners in the next 5 years. So we looked at, every now and then we sample our yearly investments against the performance of all the investments. So this is, the black line here is the share price movements, how you would have done if you'd bought all the qualifying deals in 2013 that we saw. We didn't see every single one. We saw about 80. And as you can see, it's exactly that characteristic. They do pretty well, and then they tail off. And I suppose what we're particularly pleased about with this group of investments from 2013 is they've done well, but they've also maintained this. Of course, this is still early days. And if we looked at 2014, it'd be ridiculously early days. So, but actually we're pretty confident about this group of businesses. And it's when they get past a certain point and then start to mature, you're over that particular hump. So we're very encouraged by that particular slide. Now, just to don't take too long over this, the investment bubbles look like this. And this is what I thought would be maybe a good way of putting over the portfolio as a whole in a way that makes it easy to understand, is to represent it in this form. This is Amati VCT. Now, what we're doing here is we're looking at the investments by when the original investment was made in this company. So, of course, we might have done follow-on investments, but where the original investment dates back to. And these bubbles, the size of the bubbles represents the size of the holding in the VCT. This is only the qualifying portfolio, so it's disregarding non-qualifying holdings. But these, if you like, represent the vintages, and across the graph here is the market cap. So, like all good bubbles, we're hoping these bubbles get larger, and we're hoping that they rise up this particular graph. And here you can see the 2013 investments, where a particularly good crop of investments where the bubbles have started to kind of emerge and rise up that chart. And of course, they're becoming quite large, some of these holdings. Quicksent's already made it into the top 10 holdings. And of course, if it carries on doing well, it will become larger. The 2014 ones, which have been disappointing so far, are still sort of a bit stuck down here. Here's Bilby, which is now almost in the top 10 on its, or despite the fact it's a very recent investment. And we've just labelled the ones which are top 10 investments. And you can see the Crawshaws, who are going to be presenting later, are in this group. That was a 2014 investment and a very interesting one. Despite the fact that 2014 as a group hasn't yet proven itself, we're pretty excited about some of these investments. And I'll show you how Amati VCT2 looks on the bubble graph as well. Here you can see Accesso, which Tom Burnett's going to be presenting very shortly. It's, I think, the largest investment in the Amati VCT2. It's also the oldest. Dates back to 2002. So it's one of the things to bear in mind that we as managers really often only get one shot at these. We say yes or no at the time they raise the money. If we say no, it's not going to be in the portfolio in 5 years' time. If we say yes, we live with the consequences. It's one of the characteristics of managing VCTs in particular, that's why we have to really take a long-term view in what we're looking at. We want these bubbles to emerge, and once something's over 100 million, you're really getting to the point where it's a very, very different kind of business. It's a different risk proposition. Of course, risks remain, and businesses over £100 million go wrong just as easily as ones under. But these businesses here begin to have scale, they begin to be able to use that scale effectively. And scale is hugely important when you're operating in a growth company. So I thought you might find this interesting way of visualising the portfolio as it develops. And you can see these older investments in the VCT here are a very important part of the portfolio, and they also, people sometimes ask us, what's the difference between Amati VCT 1 and 2? Well, it really is this group of older investments, which, this is Amati 1's older investments here, and here's Amati 2's. And those differences will remain, I think, for quite a few years to come, because these are good businesses that we're going to be sticking with. We absolutely treat these two VCTs equally. All new investments go into both VCTs. The differences between the VCTs in performance will only ever relate to these older holdings, which they're pretty much fixed. We can't buy them, or we can't buy the older holdings in Amati VCT 1 that are in 2, and vice versa. Share prices are a little bit misleading in this sense because Amati VCT 2 was when we did a merger with, if you remember, Amati VCT 2 had a merger with the old Invesco Perpetual AIM VCT, and at that point we rebased the share price back to 100p. It was actually much lower than that before. So if you because it's a VCT we took over the management of, and when we did a merger, we said this is a line in the sand, this merger point. We're going to rebase the NAV back to £1. So if you owned that VCT, you ended up with shares that had a higher share price, but you had fewer of them. So it's a little bit misleading to say, well, Amati VCT has a higher share price than Amati VCT 1, therefore it must have done better. The reason it's higher is because it was rebased back in 2011. Two VCs could merge, and what Julian Avery, the chairman of Amati VC2, was saying to that question was really there's one clear reason not to do that, and it's relating to the fact that there's quite a big benefit to shareholders of both VCTs to be able to, if you want to sell your investment, if you've let's say you've held it for 5 years, you no longer have a tax incentive to hold it, and you decide you want to sell it, you'd have to wait 6 months if you wanted to make a new investment in the same VCT, whereas you don't have to wait any time if you want to invest in the other VCT. So having one that's pretty similar is quite a big benefit. So hence there's a logic for keeping two. We'll move on the agenda to a presentation from one of our newest investments, a company called Crawshaws. And I'd like to invite Noel to come forward and present the company.